This will be a good conversation with Bob Elliott, who I always enjoy listening to as a fellow macro thinker. And given that I just came back from Camp Kotak, there's some interesting insights I'm sure I can throw back at Bob. So with that said, my name is Michael Guyad, publisher of the Lead Lag Report with Bob. Open mic, I know you want to talk about challenging markets, and that's what this webinar is titled. But for a lot of people, it doesn't seem like it's that challenging, right? It's like S&P keeps on going up and to the right. Maybe the challenge is in terms of overthinking what to do. But I want to get your take on where we are markets wise currently, and is it really challenging?
Well, I think that the challenge when you take a step back and as an allocator, I think the real challenge is as you get to these late cycle moments, which is really basically where we're at. And by late cycle, I mean the economy has had an extended period of expansion. It was met with tightening. The tightening, in many ways, is slowing the economy down, both sort of a fiscal tightening, meaning less negative growth policies fiscally, as well as the elevated rates from a monetary perspective. That's creating a drag on growth. And in these times, it's very challenging because the expectations of continued strength are often priced into markets and continue to get priced into markets. And that's really what we've seen just at a time when you sort of see the policy and the macroeconomic reality fading, and timing that thing right is very hard to do. And so when I think about the challenge of this environment, it's really about navigating through that sort of transition of, essentially expansion, unbridled expansion that we saw really in 23 and 24 and today, which is, real questions about whether we are on the verge of a turn or not. And so that is the challenge. I think it's easy to sort of fall into one of two camps, which is to be, everything's going to be great and it's going to boom, and S&P 10,000 and it's coming, and it's very easy to be like everything's a disaster. When in reality, what you have to be thinking about as an allocator here and as an asset manager is how do you increase your flexibility in these times, right? So that you can be flexibly taking advantage of these positive environments and some of the positive, like strong earnings growth that we've seen in the second quarter and things like that are propelling the markets higher, while recognizing that there will be a day, you don't know if it's in a week, a month, or 6 months or a year, where that probably will run out, and it'll be a more difficult environment for assets. How do you create that flexibility? That's the real question.
Yeah, and I think it's also a function of how do you even determine what asset class you need to have most flexibility to deal with, right? I mean, when people think about investing, they think about stocks, right? But the reality is there's a lot of other asset classes and areas to invest in, each with their own unique challenges. Maybe let's do a sort of a around the horn on where we are in terms of different asset classes. And I want to start off first with bonds because given the big jobs data revisions and clear slowdown on the payroll side, bets are increasing that the Fed's going to cut rates, right? Normally that would be beneficial for bonds, but we saw, an instance where the Fed cut rates and actually long duration yields rose into that. So I want to get your take on where we are in the bond market currently.
Yeah, I mean, you could kind of think about the bond market in sort of you want to think about it in two different pieces, really, which is on the front end what the Fed controls in terms of monetary policy, and on the long end, essentially the premium, the term premium of or the time premium of cash. And those two things often align, but they sometimes can diverge. And it's important to think about them from a value perspective, particularly the time value of money. It's important to think about from a longer term sort of value perspective. And so when I think about the short end, basically what we have is a circumstance where there is very, very aggressive expectations of Fed easing priced into the market. Basically a cut every meeting for the next 3 meetings and then some into 2026. And that's been beneficial to bonds sort of in the belly of the curve. But a lot of easing is priced into those markets. And so the risk there is that you get a circumstance where the Fed is not quite as generous with the easing as is currently priced in. Certainly, when you think about the overall set of macroeconomic data, you have a circumstance like the two basic things that the Fed looks at, which is core PCE, inflation, and the unemployment rate, and those two things are not really aligned with an aggressive easing cycle. Unemployment rates basically have been flat for the last year, give or take, and core PCE is above the Fed's target and rising and likely to rise further. That's not the sort of thing that would align with an aggressive easing cycle. And look, I wonder on that side of things, like people have been through this. It's been like three or 4 years where that we've sort of gone from extremes on tightening to extremes on easing to extremes on tightening to extremes on easing. We've been through these wiggles. Remember, you remember like last year at the beginning of the year, expectations were for 7 cuts to happen, and then we went all the way to 0, and then we went to a few, right? And so I think we're kind of in that cycle that's happening there, where it's not necessarily clear we're going to get the sort of easing that's expected. Now, importantly, when you think about the long end of the curve, the long end of the curve and right now from a value perspective continues to offer a great deal of value. Just look at real yields. 260 on 30-year real yields. That's 260 real return. So you get paid inflation on top of that. That's still basically at cyclical highs at a time when the economy is clearly slowing, and a time when when there is there's benefits to diversification there in terms of holding bonds, and so basically everyone in the world that you talk to hates bonds right now. I talk to folks all day, and everyone's like, well, bonds aren't a great deal. And that is exactly the time when bonds may well be the best diversifier. And strangely, and this is a little counterintuitive, a tighter Fed may actually be beneficial to bonds because it may lead to less easing than expected, right? Which would then lead to less stimulation for the economy than expected, which would then be beneficial, negative for growth and beneficial incrementally for the long end of the bond market. And so that's where you can easily have a circumstance where the Fed doesn't meet expectations of easing on the front end, and actually you get a bond rally, a beneficial bond rally, which is likely diversifying on the long end, kind of the inverse of what you just described, right? The inverse of the September 2024 circumstance.
It's funny. I thought tariffs were supposed to be inflationary, and here we are talking about the Fed cutting rates.
Yeah, well, I mean, I think that's the challenge there of the data reality, which is in many ways unambiguous that we're seeing inflationary pressures in the areas that tariffs would typically, or not typically, but do affect. So if you look at core goods prices, they've gone from deflating to inflating, relatively meaningfully, and it's enough to basically offset the services disinflation that's occurring, right? That's sort of structurally occurring, very, very gradually occurring in the economy. So we're seeing inflation rise. And you're right, it is interesting that we're seeing the circumstance where, I put out a piece recently that I said, the Fed is getting easier at a time when inflation is rising, right? And that is an unusual set of circumstances to expect, to expect a significant amount of cuts relative to inflationary pressures that exist.
You mentioned flexibility. Part of flexibility is recognizing what's signal and what's noise, right? And there's a lot of noise because everything's political, right? And there's a lot of political noise around who Trump wants to put in next for a Fed chair, right? The manic depressive nature of Trump's wording makes for Powell's job in life probably not as easy as it was under Biden. But I am curious if any of the things that you're seeing around a new Fed chair, does that impact anything? I mean, I think too often people think it's just based on one person, right? Monetary
Right.
policy. It's really not.
Right. I mean, it's important to recognize the FOMC's decision is the decision of 13 different people, and while it is a consensus-oriented organization, at times of disagreement, it is I mean, by rule, a voting organization in the same way, um, like the Bank of England is a voting organization as well. I think when it comes to the chair question, there's sort of a more strategic question here, which is, um, are we going to get someone who's in that seat who is uh, going to pursue, let's say, the dovish side of orthodox policy, or are we going, which by which I mean, today reasonable people could disagree about whether the right path of monetary policy is tightening, neutral, or cutting. All basically, you could make a totally reasonable data-driven case on all three different paths. Um, and so just because someone's on the dovish end of that doesn't necessarily mean that they're like a challenge to the orthodoxy of the Fed, right? We have existing governors who have essentially voted for cuts in the last meeting. The question is, as we move to the new chair, is the person going to be a dovish orthodox person, or are they going to be an unorthodox person seeking to basically upend the Fed's overall decision-making criteria, let's call it radically restructure the reaction function of the Fed. And so far, what I'd say is that, to the extent that Myron gives any indication of that, what you see is someone who is obviously politically affiliated with the current administration, but someone who's discussing dynamics in terms that are adjacent to the terms in which existing more dovish members of the committee are discussing things in terms of needing cuts here. And so, and when you see the various people that are being discussed, like these are not, basically all of them are not are qualified, professional economists and folks involved in the finance industry who would likely maintain the orthodox policy. And a big reason why that is because, unlike some of the other places, the Senate here is probably not going to accept a person with de minimis, what I call it. They probably won't accept a political hack. They might accept, they'll accept a professional with a tilt towards dovishness, but not a political hack. And then the last thing I'd say about it is, if we get to the circumstance where, for whatever reason, a political hack is installed, there will be 12 other members of the committee pushing to ensure that the Fed does not lose its institutional credibility. And so my guess is, if a hack was installed, they would just be ignored, in the sense of, like, they would be chair in name only, and the rest of the committee would likely operate, consistent with the rough norms institutionally.
Do we need to have a Fed chair that thinks in a non-traditional way if we're headed for stagflation?
Well, I think it becomes the question of the reaction function prioritization, and the interesting thing about this, it feels like very U.S. centric, but if you go look at what Bailey's facing over in the Bank of England, it's basically the same problem. Like their problem is actually a little harder than ours is, in that their labor markets are softer, their inflation problems higher, and this is like it is the vexing question of any central banker, is basically faced with this circumstance where inflation is rising and labor markets are deteriorating. And in almost all cases, you get essentially a push. Usually in these cases, you get a push to be a bit easier than essentially if you just looked at the data on its face, either delay or easier, which then almost always creates feedback, which then tilts you towards being tighter than expected. And if you think about where the Fed is in that cycle, in some ways we've already gone through one loop of that. right? Because what happened in 2022 and 2023 is the Fed was easier than they should have been in response to the inflationary pressures. And a lot of what we're seeing today is, amongst the people who are there today, I should say, is likely the tighter than you would have been back if you had faced the same circumstances back in 2022, because you learned the lessons of the 2022 too easy for too long. And so we're kind of in round two of that cycle there, which is, at least for the folks who are voting today. Remember, half the committee said 0 cuts through the end of the year in the last dot plot. Like, I think we quickly forget that. And that half certainly, and the rest of the folks thought either 1 or 2 more, right? I mean, it's not this is not like they were thinking we were going to cut a whole bunch of times. And so the committee itself has expressed dovish position, let's say, in terms of at least the dots that they put on paper, hawkish position.
On that round two, second round, I'm curious if, given that you're very close to hedge fund positioning, if there have been some interesting parallels or shifts akin to what hedge funds were doing in that prior cycle, 2022, and maybe just kind of talk broadly about what you're observing now.
Yeah, I think going back to that sort of flexibility point and having myself traded late cycle environments, and then seeing how hedge funds broadly are positioned there, they are nimbly holding the line, holding risk asset positions, but at the same time recognizing that you can't be just all in on S&P 500. You need to engage in some protection, whether it be protection on being bearish on the dollar or long bonds, right? Probably the most non-consensus position that hedge funds are holding right now, particularly macro funds are holding right now, is long bonds. In a world where no one wants to hold bonds, that's actually a pretty big portion of their holdings. And so that sort of set of positions, which is hold risky assets, maintain some diversification in terms of short the dollar and long bonds in case we, to sort of protect against the deceleration side of things, is it's an agile positioning, right? That they're sort of in that moment, but can easily start to take risk off on risky assets when you start to see the turn in risk sentiment, which hasn't happened yet, but may well come.
And when you say long bonds, are you talking like what duration?
Long-term duration.
Okay, so it's a very long duration. Okay, so
yeah.
Okay, so there's and from what you can tell, it's not like there's any specific betting on yield curve steepening, flattening. It's just directionally long duration yields likely come down.
Yeah, pretty much neutral on the front end of the curve, as there's a lot of pricing already priced in. And so really the question is, if you think about, if you're going to take on a bet of where will a slower growth environment most effective, where is it most mispriced? It really is on the long end of the curve, right? Where we have both nominal and real yields further out the curve, basically at cyclical highs at a time when the economy is slowing. And so that's really where the position is there. And that is, this is the thing that's I'd say sort of neat about looking at how hedge funds are positioning, is this sort of these tactical shifts are basically, these managers are able to engage in these various tactical shifts. And so just because today you're holding risky assets and seeing that right now continues to be a pretty good environment for risky assets, to the extent, for instance, that the Fed maybe expresses itself as being tighter than expected, those positions can shift relatively quickly away from long risky asset positions. And so, I think that the challenge is for the day-to-day investor is like, how can you move your portfolio as quickly as these as these hedge fund managers can move their portfolios, because they can do it. They're looking at it every day, and it takes sort of the normal folks like us a lot longer to be shifting our positions.
I know we've talked about gold before, and gold obviously has been on a tear, and a lot of the hedge funds have correctly positioned there. And have there been any sort of shifts in terms of overall weightings, though? Meaning, as gold has done this move, are you seeing less of an allocation, more of an allocation, same?
Yeah, so gold has been an interesting I think it's been a really interesting story in part because um, there were some thoughts about whether uh, the combination of the QRA uh, and the Fed meeting would indicate sort of an easier posture, or the more extreme version would be a broader, more aggressive debasement trade. Um, and I think the main takeaways from both of those events was uh, an affirmation of orthodox policy, like even in the Treasury, where Trump had said that we're going to stop all issuance beyond 9 months. Basically the policy reality has nothing changed, and so it looks like Secretary Bessent ensured that reasonableness would persist. And so, a lot of people were really all in on that debasement trade. And then what ended up happening was the orthodoxy won from the policy circle, and with it, the attractiveness of holding gold tactically has scaled back. And so what we've seen is trend managers basically neutral on gold, global macro managers holding a small amount of gold, small amount of long gold positions in their portfolio. But these are not, it's not extreme. It's quite scaled back from where we were, particularly earlier in the year, March and April, where they obviously benefited substantially from having large long gold positions.
We should talk about international for a bit because started quite strong for the first 6 months. Now U.S. is making its own relative comeback. I always joke that you don't know if you're in a cycle shift until 2 to 3 years after the cycle's already shifted, right? And which the issue with like the fits and starts when it comes to international investing. Any interesting observations when it comes to hedge fund positioning and international investing?
Yeah, hedge fund managers, again, macro managers, but also to some extent equity long short managers, were tilted towards international stocks to kick off the year and benefited a lot from that trade. And since have started to scale that back, in a lot of ways, recognizing that the valuations got a little hot in European stocks and also in Japanese stocks, and more recently, like in the last 6 or 8 weeks, have favored U.S. Positions relative to foreign positions, and so that's been sort of a good. They've been able to catch the shifts in the overall sentiment and the overall pricing pretty well through that period. I think the let's say the broad move of folks moving from being extremely overweight U.S. assets to being sort of more neutrally weighted U.S. assets, or even modestly weighted U.S. assets. That's the sort of thing that takes years and years to play out. In many ways, it's a bad trade. If you're betting on the sort of unwinding of the global overweight on U.S. assets, it is what I call a bad ratio trade, meaning that it's probably true, and it will probably be true over the next 10 or 15 years, but it's probably not, in any one month or quarter, probably not really worth it, because there's fits and starts and policy changes and underlying tactical macroeconomic dynamics that are going on in the different places, and so that's probably not going to play out. And if you look at these things back through time, like currency cycles, I spent a lot of my career looking at currency cycles, they play out over 10 or 15 years. And what we're seeing today is, post GFC, the US was in the basement, and the dollar was was very low relative to the rest of the world. And then we moved up, essentially peaking last year, about the dollar basically at all-time highs relative to the rest of the world. Think about that. That was 15 years, basically 16 years of a cycle moving in one direction, where the price action move there was probably, I don't know, 30 or 40%. Okay, well, 30 or 40% over 16-year time frame in any one day, in any one year, you hardly notice it. In any one day, you certainly make no notice of it, quarter or month. And so these sorts of secular shifts are much more valuable in terms of like those who have a decade type time horizon than those people who are looking at 3 or 6 month time horizon.
a discussion around sort of when should allocators consider a larger weighting towards alternatives?
Yeah. So when just sort of as structurally in the industry, we're transitioning from a world of 60-40 in one form or another to kind of a 50-30-20 world. And, as I say, I talk to advisors all day long, and many of whom, I spend time looking at their portfolios in order to help give guidance, help them strategically think about their allocations. And when I look at that, you basically see sort of the typical equity allocations, the typical bond allocations, and then in that 20% bucket, most of them are sort of 50-50 between what I call sort of illiquids, meaning whether it's private equity or private credit, and then more liquid alpha strategies that can go long and short. So things like hedge fund strategies. So you kind of see the world today sort of as a benchmark of 50-30-10-10. That's kind of how it is. The question about how much you should put in alts, I think, is a really interesting question. Part of this time that we're in right now is sort of everyone has benefited from equities doing so well. And the vast majority of folks are sort of overweight equity risk relative to what would be sort of a normal neutral type positioning, or a risk reduced positioning. And so given that equities have done so well, and given that you're likely overweight equity risk in one form or another, it's actually a really good time to build that diversification. Like, there's actually no better time to create diversification than when your core asset holding equities is doing so well. And so this is a time really to go out and say, where can I, take some profits and allocate it to things if we don't, that will do well if we don't have a persistent equity rally ahead. Because look, if we have a persistent equity rally, everyone's, everyone's going to be doing pretty well. But where can you allocate? And so that's where I think assets that are diversifying, like, most of the people we talk to are underweight bonds, and from a value perspective, bonds look compelling from a strategic portfolio. But also looking at things like long and short strategies, or strategies that can go long and short that can tactically navigate these sort of environments, is also very beneficial, because there will be a day in which, you're going to want the flexibility to go short risk assets in your portfolio. And if you allocate to those when stocks are high, that's the perfect time to build in that diversification.
Talk us through what you hear from FAs.
Well, I think a lot of financial advisors that I talk to on the who are looking for actively managed strategies are kind of sick of beta strategies that look like beta in one form or another. Everyone's got a more there's lots of these strategies which are effectively just more and more beta. They might call it smart beta, they might call it tactical beta, they might call it more beta. They might not call it more beta, but it is just essentially more beta. And they're kind of like, look, don't bring me things with lots of that look like stocks in sheep's clothing. Bring me things that are actually diversifying, that actually have a long track record of, having a diversifying effect on a portfolio. Challenge that a lot of advisors face, and look, it's the challenge that anyone in sort of allocation or active management faces, is there's always the uncle who has gone, in the YOLO NVIDIA trade and made a killing in one form or another. And when everything, when stocks are going up, that always looks good. And, clients are always clamoring for, let's say, trend following the up market experience. And that's where, I think a lot of the advisors I talk to recognize essentially that tension, and also recognize their role, which is to not look out for meeting the client's demand in the moment, but thinking about over the course of the next 10, 20 years, what is the best path for the client to make sure that they're going to, not just increase their wealth, but actually keep their wealth over time. And so that is I think that's the challenge that a lot of advisors have when you're, in a upcycle environment, everything looks great. It can be challenging to find to allocate and explain to things that are to investors who, assets or strategies that are diversifying to, what looks like, everything's great on one side.
Yeah, and that goes back to the weighting issue. You want more correlation towards the end of a bear market. You want less correlation towards the end of a bull market. Hard to obviously know. Goes back to that point about cycle shifts or 2 to 3 years after the cycle's already shifted. But certainly age has something to do with allocations, meaning the longer bull market is, the more likely it is just over time to age out. Um, to that end, I mean, I know you talk about evaluations quite a bit. How much more do you think the equity bull market has to run?
Yeah, I think when you're thinking about the asset market today, um, the stock market today, it's important to sort of differentiate. There is um, if you just look at, for instance, the equal weighted S&P 500, what you see is actually, there's been a rolling over uh, already, and I think that's reflective of the broader economy slowing. And so most of the gains, essentially, this last leg up has been really driven by AI speculation, in the AI oriented names. Now, I think the challenge, it's very typical in late cycle environments for certain hot sectors to get a lot of capital and a lot of and very high expectations. And it may be sort of, and every time that happens, look, people say some form of this time is different. And AI is certainly no different in that story of people saying this time is different in one way, shape, or form. Um, and it's not, it can sort of come across as curmudgeonly to be like, oh, well, it's never different. But like, if you just look back through time, and I'm saying like across cycles, equity cycles in dozens of countries over hundreds of years, the equity market does not diverge from economic reality for long. That's the reality. It does not diverge for long. And so I think when you're starting to look at valuations that are expecting extraordinary outcomes at a time when you start to see economic environments that are deteriorating, that almost always is the hallmark a of a turn. Now that doesn't mean today or next week or the week after, but the divergence between the hopes and the reality typically does not last for that long, because ultimately, I mean, if you just take the AI case as a simple example, you build all the data centers you want, and that of course is supportive to growth and valuations and chip sales and all that stuff, but like somebody in the economy has to pay for the thing that they're investing in. And if you don't have somebody in the economy paying for the thing that they're investing in, all of that investment is useless. And so far, you're not seeing that, right? Maybe it happens, but so far you are not seeing that, which calls into question whether this is an investment bubble cycle, or whether and so far you're not seeing any improvement in productivity. And so that both of those things together really raise the question about, maybe things like AI. I mean, almost certainly there's going to be some benefit over time, but what's being priced into those stocks and into the broader market right now is an expectation of a productivity boom that will happen over the course of quarters for technology that typically takes at a minimum years and most likely decades to actually be fully, the productivity benefit to be fully effectuated. And so that might set up, that's sort of setting up for disappointment at these levels.
I've had this thesis that AI would mark would be the blow off top narrative for U.S. large cap dominance. Right, that's the sort of the last sort of major narrative, right? That because that is what differentiates the U.S. and large caps from everything else. I still maintain that, but we'll see. It's certainly frustrating, right? Because we know the concentration risk is there. We know diversification should be rewarded. It's just not on the time frame that we hope it is, which is in the here and now.
Yeah, and that's why sort of going back to the top of our conversation is being able to either yourself tactically navigate, or have strategies that can tactically navigate these sorts of environments is critical, because it is very hard. Like, as a person who's been through a few cycles and has studied many more, it is very hard to know the moment when you've got the turn that's occurring. And so, you can either try and do it yourself or find others who can. And so I think, um, finding others who can is the shortcut to navigating that question of, is this the turn, or is the turn 3, 6, 12, 24 months ahead?